Most investing is built around one idea: buy low, sell high, and profit when a stock goes up. Short selling flips that entire idea upside down. It lets a trader profit when a stock falls instead. But it comes with a risk that almost no other trade carries. A loss that, in theory, has no ceiling at all. Let's break down exactly how it works and exactly where it can go wrong. Short selling comes down to 5 steps. Step 1. You borrow shares from your broker, shares you do not own. Step 2. You sell those borrowed shares immediately, at today's price. Step 3. You wait hoping the price drops. Step 4. You buy the same number of shares back, ideally at a cheaper price, and return them to the broker you borrowed from. Step 5. You keep the difference between what you sold at and what you bought back at as your profit. Let's run real numbers. You borrow and sell 100 shares at $50 each. That brings in $5,000. The stock then drops to $30 a share. You buy back all 100 shares at the new price, spending $3,000. Your profit is the difference. $5,000 minus $3,000 equals $2,000. That is the entire trade when it goes according to plan. Here is the part most people miss completely. When you buy a stock the normal way, the most you can ever lose is what you paid for it. The price floor is 0. So your downside is capped. When you short a stock, there is no ceiling on how high the price can rise, which means your potential loss is technically unlimited. If that same stock triples in price instead of falling, your $5,000 short position turns into a $10,000 loss, and it keeps growing the higher the stock climbs. Because the risk is so open-ended, short selling happens inside a margin account, not a regular brokerage account. Brokers require you to maintain a minimum level of equity in that account, commonly around 30% of the position's total value. If the stock price rises and your account equity falls below that required line, you get a margin call. You either add more cash immediately or the broker closes your position out for you, often at the worst possible moment. This risk creates a phenomenon called a short squeeze. When a heavily shorted stock starts rising fast, short sellers begin facing mounting losses and margin calls all at once. To cut their losses, they are forced to buy back shares to close their positions, and that wave of forced buying pushes the price up even further, triggering more margin calls, more forced buying, and more upward pressure. This exact feedback loop is what happened with GameStop back in 2021, when a rapid short squeeze sent the stock up hundreds of % in a matter of days. Beyond the price risk, shorting carries its own costs. There is a borrow fee, a fee paid to the broker for the privilege of borrowing shares, and it rises sharply for stocks that are hard to find, meaning heavily shorted stocks. There are dividend payments. If the company pays a dividend while you are short, you actually owe that dividend to the person you borrowed the shares from. And there is buy-in risk. Your broker can force close your position if the shares you borrowed suddenly become unavailable, regardless of what price the stock is trading at. Short selling is not just speculation. Hedge funds use it to bet against companies they believe are overvalued or built on flawed fundamentals. Long-term investors sometimes use it to hedge other positions they already hold, offsetting risk elsewhere in their portfolio. Market makers occasionally short temporarily just to provide liquidity for smooth trading. This is an advanced strategy built for experienced traders who fully understand the risk, not a tool for a beginner portfolio. Let's wrap up. Short selling profits when a stock's price falls, using borrowed shares sold now and bought back later. The losses are theoretically unlimited because there is no ceiling on how high a stock's price can rise. Margin requirements and ongoing borrow fees add real cost on top of the price risk itself, and a short squeeze can turn a losing bet into a rapid forced unwind at the worst possible time. That wraps up week 5. New videos drop again Monday. See you then.